So we outlined the basic process of cost, the basic procedure for costing a job or a process, whatever it may be in a specific situation. You trace your direct costs and then you allocate your indirect costs. Before allocating indirect costs, you decide how many cost pools you want to have. You decide what allocation base you're going to use to allocate each pool of indirect costs, and then you go ahead and actually do the allocation or the apportionment. Okay? So before we move on to activity-based costing, activity-based costing is a little more of a specialized, sophisticated, or refined version of the job costing that we saw in chapter. So before we move on to activity-based costing, you want to do this exercise that I put on the back of your packet. It's also from your textbook. It is sort of quickly review the different steps in the costing that we learned, so that we can kind of use that as a refresher before we move on to activity-based costing. Okay? So this is the Anderson construction example from your textbook, and this is a form that assembles residential houses. Okay? Now, you're told that it uses a job costing system, but you should know that this is a job costing scenario, even if you won't that is it. How do you know that this is a job costing scenario as opposed to a costing scenario? Yeah, Marissa? This is a form that comes from residential houses, right? So presumably each house is different. I mean, even though they may be constructed similar, every house is large enough and complicated enough that this is an example of a firm that needs to do job costing. Now, they use a job costing system with two direct cost categories, materials and labor, and one indirect cost pool, which is just called assembly support. Okay? So the fact that they have just one indirect cost pool should automatically tell you that they're taking all of their indirect costs and they're lumping them together, and they're going to allocate them using a common allocation base. Okay? So what is that allocation base? It's direct labor hours. Now, in December 2006, they had budgeted assembly support costs to be 8 million and had budgeted direct labor hours for 2007 to be 160,000 hours. So these are the budgeted amounts that were forecast in 2006 for the year 2007. Okay? Now we are at the end of 2007, and Anderson is comparing the costs of different jobs that were started and completed in 2007. So now we fast forwarded in time by a year. Okay? And you're given information about two models. The first model was constructed between February and June. The second model was constructed between May and October, so different starting and ending periods. You're given information about the amount of direct materials, the amount of direct labor that were extended on each model. So this is information about the direct costs, right? So do you have to do any direct cost tracing in this example? No, because it's already been done for you. You're already told what the direct costs are that are associated with each job. And then finally, you're told the number of direct labor hours that were expended on each model. The Laguna model had 900 direct labor hours expended on it, and the Mission model had 1,010. Okay? Okay, now materials and labor are paid for on a contract basis, and the costs of each are known as the materials are used or the labor hours are worked. The 2007 actual assembly support costs were 6,888,000, and actual direct labor hours were 164,000 hours. Okay, so really you're given 5 or 6 different pieces of information, and very little math that you have to do in costing exercise. The only math that you have to do is allocation math. The rest of it is identifying the relevant information and putting it into the right place. Okay, so there are 3 specific requirements, but really the overarching requirement is for you to determine the overall cost of each model. Okay, so this is the first one, and this is the second one. Now, last class we distinguished between something that we called actual costing and something that we call normal costing. Someone described to us the difference between the two approaches. Yes, Guido? Yeah, actual cost numbers related to what type of cost? To what type of cost? Okay, go ahead and finish your description, and then we'll
Well, normal costing is just picking up the fixed budgeted amount of
Yes, yes, yes. So there's a small refinement that we have to make to that definition. Okay, you're absolutely right. Actual costing is done entirely using actual realized numbers. And when are these numbers available? They're available at the end of the period, right, or after the job is done. Whereas normal costing doesn't completely use actual numbers, but some of the components in there are budgeted or predicted or forecasted numbers, and those numbers are decided when? At the beginning of the period. Okay. Now, actual costing and normal costing are identical in their treatment of direct costs. The direct materials cost and the direct labor costs are going to be the same across actual and normal costing. They only differ in their treatment of the overhead or the indirect cost. Okay? If you remember from last class, in actual costing, we use the actual overhead that was incurred over the period and divide that by the actual quantity of the overhead allocation base and come up with an actual overhead allocation rate. Whereas in normal costing, we do not use an actual overhead allocation rate, but a budgeted or forecasted overhead allocation rate, and that budgeted overhead allocation rate is the result of taking budgeted overheads for the period and dividing them by the budgeted quantity of whatever allocation rate you're going to use. So it's not just that actual and normal differ in their use of actual numbers as opposed to budgeted numbers. Actual and normal costing differ only in their use of an actual overhead allocation rate as opposed to a budgeted overhead allocation rate. Okay? So let's cost the two jobs under both costing approaches. Okay? Okay, so let's start off with actual costing for the Laguna model. Any cost allocation exercise, the very first thing and the easiest thing for you to do is to assemble the direct cost information and put it in the right place. Okay, now the Laguna model has two direct cost categories attached to it, right? Materials and labor. So, and you're simply told what they are. So you take them and you put them in the appropriate place. So materials cost 106,450 and labor cost 36,276. Similarly, the mission model has materials that cost 127,604 and labor that costs 41,410. Okay, now what do we have to do next? What do we have to do next? Are we done costing, or is there more steps? So what is it? Identify the allocation base and use that to allocate the overhead, right? So in this case, you are told what the allocation base is. You are told to use direct labor hours as an allocation base. Okay? So just add another column here. Your allocation base is direct labor hours. Okay? So if you want to think about it one way, you can first calculate an overhead allocation rate. That is a certain number of dollars that you're going to allocate per direct labor hour. Okay? And remember, since we're doing actual costing, our overhead allocation rate is going to be based on actual realized information for the year. Okay? So what is our actual overhead allocation rate going to be composed of? How do we compute it? Sorry? The actual overhead divided by what? The actual total quantity of whatever it is you're using as the allocation base, in this case, direct labor hours. Right? So your actual overhead allocation rate is going to be the actual overhead that was incurred in 2007, 6,888,000 divided by 164,000 hours, because that's the total number of hours that was worked in that period. So go ahead and scale that and tell me what your overhead allocation rate works out to. $42, thank you, per direct labor hour. Okay? So now that you have that information, you can use it to calculate the overheads allocated to both of these models. What is the overhead allocated to this model? Now, how much overhead would you allocate to this model given what you've computed? That's correct. So you're going to allocate overhead at the rate of $42 for each direct labor hour that is worked on a specific job. And you were told in that box there that you worked a total of 900 direct labor hours on this job. Right? So the total overhead allocated to that job is going to be 42 per direct labor hour times a total of 900 direct labor hours. Okay? And similarly for the mission model, what is the total number of hours that was worked on the mission model? You worked, say, 1,010 hours. Okay, and you're going to allocate overhead at the rate of $42 an hour. So the total overhead allocated to the mission model is going to be $42 per hour times 1,010 hours. And you can go ahead and calculate what those numbers are. And then you aggregate the direct costs and the overhead allocated, and you come up with your total cost estimate. Any questions? Now, if you want to think about it in a slightly different way, you can. This is just one way of thinking about the allocation logic. You could also think about the overhead allocated in the following way. We worked a total of 164,000 hours on all the jobs that we did that year. Out of that 164,900 hours were worked on this job that we are trying to cost now. Therefore, this proportion of the total hours was devoted to the Laguna job. And therefore, we allocate to the Laguna job the same proportion of the total overhead that we are trying to figure out how to allocate. So, okay, if you want to follow a similar logic here, again, we worked a total of 164,000 hours on all jobs, out of which 1,010 was devoted to this job. So the mission model consumed this proportion, or this percentage of the overall direct labor hours, and therefore you allocate to it the same proportion of your total overhead. Write down both of the ways, calculate the overhead that you get with both approaches, and confirm to yourself that they give you the same answer. Okay? Any questions? Or 42 times 900. Okay? Any questions? If there aren't any questions, go ahead and calculate the normal costing numbers on your own. Okay, so how does normal costing differ from actual costing? How does normal costing differ from actual costing? But specifically, which numbers do you use the budgeted forms of? Do you use budgeted versions of all these numbers? You're not given the budgeted versions of the direct materials, direct labor, and so on. So what is it that you replace with, which number specifically do you replace with its budgeted version in normal costing? Sorry? Amount of hours? Go back to your notes, look at what they say and tell me. What is the sole point of difference between actual costing and normal costing? Yes, anyone? The budgeted overhead allocation rate, right? Instead of the actual overhead allocation rate. Now, do you replace anything else? No. Everything else continues to remain the same as it does in actual costing. The only point of difference being that you replace the actual overhead allocation rate with its budgeted version. Okay? So really the only thing that you have to do differently here is to recalculate the overhead allocation rate but with budgeted numbers. So how will that be computed? How is that computed? Sorry? That's precisely right. 8 million divided by 160,000. Make sure you use budgeted versions of both numerator and denominator. Okay? So that's going to give you a budgeted rate of $50 per direct labor hour. And so you carry over your direct materials, the direct labor number, those stay exactly the same. Only the overhead allocated changes. Now you allocate overhead using the budgeted rate of 50. Okay, any questions? Now that you use normal costing, suppose you use normal costing in Anderson construction, are you going to end up with over-allocated or under-allocated overhead? Are you going to end up over-allocating or under-allocating your overhead? Over-allocating your overhead to the tune of $8 per direct labor hour. Okay? So all of your job costs will be slightly overestimated when you compare them to the actual overhead that you incur at the end of the period. Now this difference of $8 per hour, you can only figure out at the end of the year once the total numbers have come in. Okay? So at the end of the period, before you close your books, you're going to pass some adjusting entries that threw down the cost of each job by a proportion of $8 for each labor hour spent on that job. Okay? So normal costing gives you more timely information. You don't have to wait until all the jobs are done to figure out the allocation rate, but the trade-off that you incur for that timeliness is that you lose a little bit of accuracy. So you have to make those adjusting entries at the end of the period to reflect the true actual cost. Okay? Any questions about normal or actual costing? Okay, so let's talk about the situations where this kind of approach doesn't work. Okay, because that's what we deal with in Chapter 5. Okay, so Chapter 5 is called activity-based costing, and many of you will be happy to know that it does not refer to a different type of costing. Okay, the cost allocation technique in activity-based costing is very similar to what we studied here. There's no different logic. Allocation always uses the same logic. You take an indirect cost and you try to split it up into many chunks based on the proportions of something else, of some resource or some activity. Okay, so that logic stays exactly the same, just the way that you do it changes a little bit, the mechanics change a little bit. But let's talk first about what are the limitations or the inaccuracies of this very simple method of costing that necessitate sort of a more sophisticated approach, such as, for example, ABC. Now, we talked about many different types of costing last class. We talked about job versus process costing. We also talked about actual versus normal costing, right? But all of this stuff that's on the board and which we talked about last week also goes by another name. It is also called simple costing, okay, or traditional costing. And here's the reason why it's called simple costing. Because the way in which you allocate overhead in all of these examples has been pretty simple, right? So let's take the Anderson construction example or the Robinson example. Think of whichever one you're able to remember the facts more for. So we basically grouped all the overheads together into a single cost pool here and in the Robinson example, and we allocated it at one go using a common allocation base, right? Now think about, that seems very sort of easy to do and you sort of did it without thinking about it too much, but think about all the different overheads that might have gone into this into this cost pool that's sitting here inside this 6.8 million. Do you think that entire 6.8 million pie is made up of one particular type of overhead cost? Unlikely, right? It's probably in all likelihood made up of many different types of overhead costs which have all been pooled together, and which for simplicity's sake we have made a sort of assumption that we're going to allocate all of those costs using the same proportions or using a common base. So let's try to think of some of the items that might have gone into this overhead cost pool. There's probably some salaries in there, right, for your supervisors, your foremen, your managers. There are some maybe repair and maintenance costs in there. There are other things like rent, electricity, utilities, and so on, right? Now, in an ideal world, if you had perfect information, and if you were able to hire as many accountants as you could to keep track of all your data, you would allocate each of these overheads using its own allocation base, right? So rent you would maybe allocate using space, electricity and utilities perhaps using machine hours, repair and maintenance using machine hours or labor hours, salaries using, again, either machine hours or labor hours. You would go item by item and you would come up with an independent and individual allocation base for each category, right? But we haven't done that here. Here, what we've done is made a simplifying assumption that each of these overheads can be divided up amongst your jobs in the same proportion, in the same way. Okay? And you recognize that that introduces some inaccuracies into your overall costing number, right? Because it might be that whatever base that you picked, direct labor hours here in this case, works pretty well for some of the overheads that are contained in this pool, but works not so well for some of the other overheads that are contained in this pool. This is intuitive to everyone? Right? So the fact that we combine all of our overheads together into a relatively small number of cost pools introduces some inaccuracies, and until now we sort of accepted those inaccuracies because of what they give us in the trade-off. They give us a very simple system. Okay? In many manufacturing examples, predominantly for most of the manufacturing that happened in the US in the 50s and the 60s, this kind of simple costing system was enough. All the inaccuracies that it created weren't such a big deal. Okay? But over a period of time, the limitations of a simple costing system have become more and more. And there are two main trends, or two main things that have happened in the industrial world that have sort of caused the simple costing system to break down. The first thing that's happened is that you have in more and more companies a greater diversity of products being made under the same roof. I'll repeat that. A greater diversity of products being made under the same roof. Okay? And just to think of some examples of that, think of Coke or Pepsi. Okay? Think of how many different types of brands or different types or varieties of Coke they put out in 1950, and compare that to the number of brands, the number of varieties that they put out today. There's a vast difference, right? So even within the same company, there's a much greater diversity of products being made under the same roof. Another example is any kind of bank. Take Citibank. Okay? 50 years ago, when it started for business, it did only one thing. What is the one thing that Citibank did? It did retail banking. What does retail banking mean? What is retail banking? That's right. That's right. Taking deposits and then transforming them into loans, having checking accounts, saving accounts, and so on. That's the only thing that they did. But now, if you go to a Citibank branch, there are hundreds of things that you could do. You can park your investment money there. You can have them do your personal financial planning for you. You can have them buy and sell stocks, different types of money market funds, put your money in CDs, do your retirement planning, do all types of foreign currency transactions. There are hundreds of things that you can do. So in all industries and in all sectors, the variety of things that happen under the same roof has increased dramatically. Okay, now what does this have to do with costing? And it's very intimately related to costing. Okay, so think of an extreme example of a company that makes only one product. Okay, a one-horse show, just makes one product. It's very difficult to think of realistic examples, but hypothetically, okay, just makes one product. Is overhead allocation a big deal for these guys? If not, why? There's only one product to worry about, so do you even have to do allocation? No, there's no allocation. Now, the question of allocation only comes into account when you have more than one cost subject that's jointly incurring a cost. Okay? Now, expand that slightly. Imagine not one but two products, but imagine two products are very similar. Okay, let's suppose you make widgets, and then you make a red widget and a blue widget. Okay, they're very, very similar. So hypothetically, they're two different cost objects. Let's suppose maybe you package them differently, or they have different markets, or whatever it may be. Again, is cost allocation that big of a deal for this company? Again, no. Even though they have two products, they're two very similar products. And the fact that you have similar products means that each of your products is going to consume approximately the same combination of all your overheads. Right? So you might as well just take all your overhead and then just divide it into two and you're done with the allocation. Now, tweak that up a little bit more. Now, imagine that you have two products, but you have two very dissimilar products. Suppose you have one product that's very simple in design and you have another one that's relatively complex. Okay? Now, can you just take your overhead and divide it into two and be done with it? You intuitively all recognize that you cannot, right? And why is that? Because the complex product is going to consume a very different combination of all your overheads than the simple product, right? So you need to account for that. So now, keep pushing that example more and more. Imagine a greater and greater diversity, many different kinds of dissimilar kinds of products under the same roof. You're going to have each cost object using up a very distinctive combination of all those different overheads that you have there. So naturally, you realize that you have to pay a lot more attention to your overhead allocation in a situation like that. And we have today much more diversity in the kinds of products that companies make than we did many years ago. So we naturally need to think a little bit more about cost allocation. The second thing that's happened is that production has become more automated. When production becomes more and more automated or mechanized, how do you think the total makeup of your costs shifts between direct costs and indirect costs? Please repeat the question. And how do you think the total makeup of costs shifts between direct and indirect as your production becomes more automated or mechanized? Eric? Precisely. So when you have a manual or sort of a handcrafted production process, a big component of your cost is going to be direct labor, right? But then when you start replacing people with machines, now the cost of those machines is other things like depreciation, repair and maintenance, buying supplies, having a team of engineers on hand to support that process. All of these tend to generally not be direct costs but indirect costs or overhead. Okay, so as you automate or mechanize, the makeup of your costs shifts from being predominantly direct to being predominantly indirect. So you all know that in the last few decades we've had increasing automation or mechanization. We don't have sort of small handcrafted styles of production anymore, right? So overheads in general have become a much bigger proportion of your total cost, so that again makes it more important that we allocate them properly. Okay? So two main trends: greater product diversity within the same roof, and also an increasing importance of overheads in your total cost makeup. Combination of these two factors means we've had to reconsider the way we do overhead allocation over a period of time. So let's do a very, very simple kind of homespun example, hopefully one that you guys can all relate to, that illustrates what happens when you have a costing system that's too simple. Okay? What the consequences are of having a costing system that's too simple, and why are those consequences important? So this is the Andy and Bob example. Okay, so roommates. The roommates share an apartment. Now suppose their apartment is 2 rooms of exactly equal size, and they each have 1 bedroom. Monthly rent is 1,000. Okay. Now suppose also the monthly rent is 1,000. Now suppose also that the electricity bill for June was 100. The landlord gives him a single bill at the end of each month that bundles in both the rent and the electricity for 1,100. So we have two types of costs that are being incurred. They're being bundled together into a single pool, into a single bundle. Okay. Now, since Andy and Bob use roughly half of the apartment space each, okay, they split the bill into half. So that means each person pays 550. Okay, is clear to everyone? The setup? Now, however, Bob is very unhappy about this. Okay, now we go to the landlord and ask for a detailed breakdown of the electricity bill. The $100 bill comes entirely from the use of the air conditioners in each bedroom. Okay, so it's simplifying assumption. Okay, it's not realistic. Now, further investigation of the bill reveals that Andy, who works mostly from home, has used the air conditioner for 90 hours this month, whereas Bob, who works mostly in his lab in the school, has used the air conditioner only for 10 hours. Okay? Now that you have this additional information, how would you suggest they reallocate the bill? Would you suggest that they reallocate the bill, and if so, how? Okay, continue, finish. Yeah, so go ahead and do that. Instead of telling us how you would do it, just go ahead and do it. Okay. Just do the numbers instead of telling us what you would do, please. Yes. So let's call this the old system. Okay? And what we're trying to do is we're trying to figure out a new system. That's right. Yeah. That's right. Are you quite sure that that makes sense? It's a very simple question, okay? There's no need to complicate it more than necessary. What you did before was you bundled both cost items together and you divided them by half. What was the logic behind dividing the two costs in half? Equal usage of space, okay? So now somebody's unhappy about this allocation. So obviously it means that the equal usage of space assumption is a little too simple. We need to refine it. We need to tweak it a little bit. So now we're giving this additional information. Go ahead. You had your hand up, yeah? Correct. So you basically, instead of allocating the two of them together in a bundle, you allocate them separately. That seems like what you would do given this information. So the rent, you still continue to split in half. There's no reason to change that up, right? Because the rent is the payment that you make for space and they use half of the space each. But now the electricity bill, you would split in what ratio? 90-10 or 9:1. Right? So 90 and then 10. So you have 590 and 510. This is clear? Okay, so it's a lot simpler than what you had going on. Okay, it's not a trick question; it's a very simple one. So, so now it's sort of obvious why one person was unhappy with the allocation before, right? So, if you want to translate this is set up in terms of people and costs that we can all recognize. But the same kind of inaccuracy can show up even in a corporate setting where A and B were products instead of people. Okay? So let's make that slight switch into a corporate setting. Now, if you want to translate what's happening here into managerial accounting parlance, we would say that in the old setup, one of these people was being overcosted and another one was being undercosted. Now, who was being overcosted and who was being undercosted? Who was being overcosted and who was being undercosted? Yes, you? Bob is being overcosted and Andy was being undercosted. So if you want to really understand what these words overcosting and undercosting mean, just look at these numbers, right? Bob was consuming resources with a value of how much? 510, but he was instead being charged a greater amount, namely 550. So this is what we refer to as overcosting. When you have someone or some product consuming a low value of resources but being charged or being allocated a cost that's higher than that. And then Andy was being undercosted. So he was in fact consuming resources that had a value of 590, but he was only being charged or only being allocated or only being costed 550. Okay? So by virtue of the fact that one of these guys is being undercosted, the other one is being overcosted. Now you recognize, whenever you have overcosting and undercosting, it always happens to a pair of people or to a pair of things. Can you just have one product being overcosted or undercosted and no other product being inaccurately costed? You cannot have that. You can never have overcosting or undercosting happen only to one product, because whenever one product is overcosted, it means by definition that something else is undercosted and vice versa. So it always happens to at least two products. Okay? So by virtue of the fact that Bob is paying more than his fair share and he's paying less than his fair share. So this kind of behavior that's going on here we call cross-subsidization. Okay? Now who is subsidizing who and to the tune of how much? Are you sure? B is subsidizing A, right? Because B is paying $40 more than his fair share, 550 minus 10. But virtue of the fact that he's paying 40 too much, this guy is paying 40 too little. So this guy is giving the subsidy and this guy is receiving the subsidy. Okay, question? Yeah. Does someone else want to answer that question? Why did we not apply this 90%, 10% ratio to the entire 1100? Jennifer? Because what's the idea of splitting? The idea of splitting is to reflect how much of each cost has been used up by each individual, right? So if we were to apply the 90%, 10% ratio to the entire thing, we would also be splitting up the rent in 90-10. Does that make sense? Okay. Okay. So translate this intuition into a corporate setting, and you could just as easily as you have here a person being overcosted and another one being undercosted, you recognize if you have a costing system that's too simple, you could have one product being overcosted and another product being undercosted. Okay? And you could have one product subsidizing another in the costing system. Okay, so this is the consequence of having a costing system that's too simple. So really what we showed here is just an example of a costing system or a cost allocation system, right? Because you had two costs. Now, how many cost pools did you bundle those two costs into? How many cost pools did you have? Just one cost pool, because you bundle them together into a single number. And what allocation base did you use for that one cost pool under the old system? What was the allocation base that we were using? Implicitly. Space, right? Equal space, so we use a 50-50 ratio. Now, what we did with the new system was simply to take the old system and refine it a little bit. Now, instead of bundling both costs together into one cost pool and having one allocation base for both costs, what did we do? We split them up into two cost pools, and we had a different allocation base for each cost. We allocated the first cost using space, like before. We allocated the second one using hours. Okay, so this is just it looks very simple, but this is a very classic example of what happens when you have a overly simplistic costing system and how you can go about refining it. Okay, now why overcosting and undercosting are such a big deal in a corporate setting? There's a couple of reasons why. Now, overcosting and undercosting is problematic because, like I mentioned before, it rarely ever happens to one product at a time. Okay, suppose you have two products in total, and you realize that one of them is overcosted. What does that mean about your product range? It means that your entire product range has been costed inaccurately. Okay, so overcosting and undercosting always affects a group of products at the same time. So it means that a number of product costs that you're estimating are inaccurate jointly at the same time. It never strikes just once. It always strikes multiple products. Okay, now even suppose you have some over or undercosting, why is it a problem? Why is having overcosting or undercosting a problem? That's the definition of overcosting or undercosting, right? So the question is, why is that a problem? What consequences does it have on the business? If you overcost something or if you undercost something, what immediate consequence does that have? Eric? You overprice or underprice. Right? If you overcost something, chances are you're going to overprice it. What happens when you overprice? You lose market share. You drive away customers unnecessarily. Right? What happens if you undercost something? You tend to underprice it. Now, what happens when you underprice? You don't lose market share. You typically gain market share. But unfortunately, that gain of market share tends to be poisonous because you're gaining all those additional customers, but you're not making a profit by selling to them. You might actually be losing money while selling to them. So you eventually put yourself out of business. So real economic consequences. Now, the third reason why overcosting or undercosting is such a problem in a corporate setting relates to how a corporate setting is different from this. In this example, how did you identify that there was overcosting or undercosting going on? How did you identify? What did you need me to tell you for you to identify that? So what piece of information did you need for me to tell you in order for you to identify that there was overcosting or undercosting? You needed the information about the number of hours, the consumption of the electricity, right? The minute I told you that, you were able to figure out what the true split of the indirect costs should have been, and then you figure out these two numbers, and then it becomes immediately obvious, we have some subsidization going on here. Now, the problem in a corporate setting is, do you know what the true split of the indirect costs is? So somebody gives you a bunch of overheads. Do you know what the true allocation of those overheads should be? You don't know that. Does everyone recognize this? You don't know this, the equivalent of this. Okay, because nobody tells you that information. You don't have that data. And whatever it is that you're trying to do is trying to approximate, trying to figure out what the true split should be. So all you have really are these numbers. You never have these numbers because you're trying to figure out what these numbers should be with all the allocation that you're doing. Okay? So when you don't have the true split or the true allocation of the overheads, how do you identify that you have overcosting or undercosting? How do you diagnose that you may have overcosted or undercosted products? Yes? But again, what is the benchmark? How do you know that your revenues are too high? Okay. Why? You might just not be doing a very good job of advertising your products this year. How can you distinguish between the two? You understand my response? Okay. Yes. That's one way, right? But regardless of how you think about it, that's really one key way in which you can identify. You have to intersect what you have with some external information from elsewhere in the market. You have to have some external reference points for your prices and your costs that are not related to your internal cost accounting system. That's really the only way in which you can begin to diagnose that you may have overcosting or undercosting. Look at the price points that you're selling at. Identify your closest competitors. Look at the price points that they're selling at. Even that is imperfect because they might be pricing their product lower than you because they make their product at a lower cost. Okay? So it's very difficult. You get to that, you diagnose the problem using a combination of different factors. That's exactly what we're going to do in the Plastin example. Okay? So this is the sort of big case in your textbook that relates to activity-based costing. It relates to very, very nice setup. It's set up like a kind of a detective story, actually. So we go through it step by step. We diagnose what the problem may be. We identify that there may be some overcosting or undercosting, and then we figure out how to fix it. Okay? So let's jump into the Plastin example. Okay, so Plastin is a corporation that makes lenses, okay, for automobiles. Now they make two types of lenses, the simple lens and the complex lens. So the complex lens is a large lens with many special features, such as multicolor molding, etc. It's obviously more difficult to manufacture. Okay? The simple lens, on the other hand, is easy to make. So this year, Plastin made 60,000 simple lenses and 15,000 complex lenses. Okay? Now you're given a bunch of information about the lenses. So let's put all of that down here. So while I'm erasing the board, you can look through the numbers in the example. Okay, so this is Plastin. Let's make one column for the simple lens information. Let's make another one for the complex lens information. Okay. The totals on this side, and let's put per unit data on this side. Okay, so the first piece of information you have is about the direct costs. Okay, so direct material costs, 1,125,000 for the simple lenses. Now, per unit direct material costs are $18.75. How do you think they arrived at this number? They took the total cost and they divided it by the number of simple lenses, which is 60,000 in this case. Okay, so get this. Now, direct material costs for the complex lenses, 675,000 in total. Now, per unit, 45. So, right now, it's sort of consistent with our intuition. The complex lens is a much larger direct material cost, which is as it should be because it has many more parts and so on. Now, direct labor, 600,000. Okay, so direct labor per unit is 600,000 divided by 60,000, $10 of cost. So 195,000. So on a per unit basis, comes $13. Okay. All right. So that's the given information. Now let's turn to what else is given. Now the indirect costs, the overheads, largely consist of salaries paid to supervisors, engineers, support staff, and maintenance staff, all of whom support direct manufacturing labor. Okay, therefore, Plastin uses direct manufacturing labor hours as the only allocation base to allocate indirect costs to simple lenses and complex lenses. Now, you can clearly see right off that this is a simple costing system, right? Because they group all of their overheads together into one bundle, into one pool, and they're allocating them using a common base, namely direct labor hours. So this year, Plastin used a total of of 39,750 direct labor hours, out of which 30,000 was spent on the simple lenses and 9,750 was spent on the complex lenses. Okay, this is the total direct labor hours worked, and they seem to have been divided up between the simple lenses and the complex lenses in approximately 3:1 ratio. Okay. Since Plastering uses only a single overhead allocation base, it groups all overheads into a single cost pool, and that single cost pool totals 2.385 million. Okay, so these are the total overheads to be allocated is 2.385 million. Okay, so go ahead and allocate these overheads to the simple and the complex lenses. Ask me if you don't know what to do. Okay, so there's two ways in which you can think about this overhead allocation exercise. You can think about it the following way. What proportion of the total hours is used by the simple lens? What proportion of the total hours worked was worked on the simple lens? 30,000 divided by what? 39,750. This is approximately 75%, right? And therefore you allocate to the simple lens the same proportion of the total overheads. And what does that work out to? What does it work out to? $1,800,000. Okay. Now for the complex lenses, well, the complex, you could just simply take the 2.385 million, you could subtract the 1.8 million from it, and you will arrive at the overhead allocated to the complex lens, because the two have got to add up to the total, right? But if you want to work through it step by step, the complex lenses use this proportion of the total direct labor hours worked, and therefore you allocate to them the same proportion of the total overhead, and so that's going to work out to 585,000. Okay, so that's one way to think about it. Allocated 1.8 million and 585,000. Now, if you want to use an overhead allocation rate to do the allocation, that's also acceptable. What is your overhead allocation rate going to be? Can I have someone tell us what the overhead allocation rate will be? How it will be computed? 2.35 million divided by, is it 30,000? 39,750, the total hours worked. Okay. Now, very common mistake, perhaps the most common mistake that I've seen in overhead allocation is for students to do the following. Do something like this to figure out overheads allocated to the simple lens, and then do something like this to figure out the overhead allocated to the complex lens. Now, you know that this is wrong, right? Okay, it doesn't make any sense. What is the point of allocation? The point of allocation is to take this number, to split it up into many pieces, but when you add up all of those pieces and put them back together, what should you get? You should get this. Okay? And when you do all this stuff, you end up with two numbers that don't add up to anything that is relevant to us. Okay? So, if you were to figure out an overhead allocation rate, that would be 2.385 million divided by the total hours, 39,750. Can anyone tell me what it is? $60, thank you, per direct labor hour. And therefore, the overheads that you allocate to the simple lens are going to be 60 per hour times however many hours worked on the simple lens. The complex lens is going to be 60 per hour times the 9,700. And you'll get the same answer if you got that. Okay? So you can use either of these two approaches, like I've told you many times before. Use either of the two approaches, whatever makes sense to you. Now, what would the overheads be on a per unit basis? To translate the total overheads into per unit overheads. What will they be? Translate the total overhead into a per unit number. $1.8 million divided by 60,000, which is going to be what? 30. And 585,000 divided by 15,000, which works out to 39. Okay. So far, every complex lens gets $39 of overhead allocated to it, and every simple lens gets 30. This is again consistent with our intuition, because you kind of know intuitively that the complex lens needs to have more overhead allocated to it. Right? Because it's more complex, it consumes probably a greater proportion of the time of the supervisors, the time of the designers, the repair and maintenance people, cleaning, setting up, dismantling, and so on. So right now everything seems kind of consistent with our intuition. Now let's figure out the total cost of each of these, and we're just going to work with the per unit data from now on. Okay? So the total cost of each simple lens is $58.75. The total cost of the complex lens is $97. Okay? So each simple lens costs about $60 to make, and each complex lens costs about $97. Any questions so far? No questions, right? Okay, so now if you look at your handout, you're given some additional data. Okay, and what does that additional data relate to? It relates to price. Okay, you're also told the price at which you sell each simple lens and each complex lens. So let's put that down here. What is the price of each simple lens? What's the price of each simple lens? 63, thank you. And the price of a complex lens is 137. So now that you have the price per unit of each type of lens, and you also have the cost per unit of each type of lens, if you offset one against the other, what does that tell you? It tells you the margin or the profit or the income that you make on each simple lens and the income that you make on each complex lens. So go ahead and figure that out. So each simple lens makes you $4.25 in margin, and each complex lens makes you $40 in margin. Everyone knows where I got these numbers from. They're on your packet. Okay? All right. So now that we have the margin, or the profit that you make per unit of each type of lens, we can compare how profitable the simple lens is to how profitable the complex lens is. But there's one more thing that we need to do. Now, what's the problem with comparing the 425 directly to the 40? Is that a useful comparison? If yes, why? If no, why? Comparing the 425. So I want to get a picture of how profitable each type of product is, and relative to each other, which is better, which is worse, and so on. So what's the problem with comparing the 425 directly to the 40? Is there a problem? And if there is, then what's it? Does anyone have an idea?
I think the per unit prices.
The per unit prices are different. Okay. Keep going. That's it. Okay. Does anyone else want to elaborate? Why? The question is, why is it not very meaningful to compare the 425 directly to the 40? Different products, different prices, but it all relates to this number. Okay? So it's a different cost. It's a different amount of investment that you have to put into making 1 unit of each simple lens as opposed to 1 unit of each complex lens. You only put $68.75 into making each simple lens, whereas you put a much larger amount of money into making each complex lens, right? And that's why you can't directly compare the margin from each of these two products. Even if it were two different products, if the investment in those two products were identical, you could just simply take whatever dollar margin you made out of those products and you could compare them directly to each other. But you understand in this case why you can't. Because you've invested a lot more in making each complex lens. So naturally, if you want the same return on your investment, the complex lens has got to give you a higher dollar margin. So the question is, does the complex lens give you a sufficiently high margin to compensate you for the greater investment that you make in it? So the general message is that anytime you want to compare the profitability of two or more products that are different from each other, you can never take the dollar profit and just compare it directly. You need to take the dollar profit and you need to scale it by something. Okay, you need to use some scale number. Now, anytime you take a dollar profit and you scale it by something, that becomes a sort of a percentage number. Okay, so we call that a profit percentage or a profit margin percentage, and the profit margin percentage can be calculated in many different ways depending on what you use as the denominator. Now, a very, very common scalar or denominator is to take this profit and to divide it by the price per unit. Okay, so go ahead and divide both these margins by the selling price and tell me what numbers you get out of that calculation. What does the profit margin percentage on the simple lens work out to? 6.7%. And on the complex lens? Approximately 40%, right? Okay. Approximately 30%. Okay? Alright, thank you. So, how to interpret these numbers? Well, here's how you interpret them. For every dollar of revenue that you make on a simple lens, you retain how many cents in profit? 6.7 cents. But for every dollar of revenue that you make on a complex lens, you retain almost 30 cents in profit. So, dollar for dollar, the complex lens is significantly more profitable than is a simple lens. So, now that we've completed all the information that we were meant to put into that format, let's look at both the simple lens and the complex lens and let us form a picture in our minds of what kinds of products each of them are. Okay? So, when you look at the simple lens, here's all the information that you know about it. large market, right? There are 60,000 simple lenses that are made, okay? Each simple lens gives you a relatively small profit. It's just a few cents, okay? So a simple lens definitely seems more like a high volume product, whereas the complex lens is a low volume product. But what compensates for the fact that the complex lens is a low volume product? High margin, right? So one way to describe the complex lens would be it's low volume but high margin, whereas the simple lens is high volume but low margin. So which of these products does it seem like you're competitively pricing, and which of these products does it seem like you're pricing at a premium? Yes, so the simple lens seems to be competitively priced, right? By competitively priced, we mean priced to give you a relatively low margin. So competitively priced. So everything points towards the simple lens being a kind of a cost competition or a price competition kind of product. First of all, it's simple, so that means kind of standard. Many other people might make it. Large market, but relatively small margin competitive pricing. The complex lens, on the other hand, looks like it's being priced at a premium because we're making a relatively large margin of 30% on each complex lens that we sell. And it's also complex, so it's probably specialized. Not everyone makes it. Small market. So it seems very much like a differentiated kind of product. Okay, now hold this thought, because there's one more piece of information that I want to throw at you guys and I want to make you think about before we leave. Okay, so an unpleasant surprise at Plaston Co. Okay? So one day Plaston gets a letter from Giovanni Motors, its main client. The letter basically indicates that a new supplier is willing to supply the simple lenses to Giovanni at a price of $53, which is much lower than Plaston's current price of $63. So unless Plaston is able to lower the price on the simple lenses, it's going to lose its main customer next year. Now, Plaston CEO, you guys are Plaston CEO, talks directly to the purchasing manager at Giovanni about this. Now, amongst other things, the purchasing manager assures Plaston that their business for the complex lenses is safe, as Giovanni considers the complex lens price of $137 to be a very attractive price. Now, what does it mean when a customer tells you that your price is attractive? It means it's high or low? Low. It's reasonable, like it's something that he's willing, it's fairly priced, yes, according to him, right? So what's puzzling about this development? So let me rephrase for you what happened. We get some feedback from our major customer that says really two things. First of all, the complex lens seems to be very reasonably priced, but the simple lens, from the customer's perspective, is overpriced because in the most straightforward possible way, because the customer's found another guy who's willing to supply the simple lenses to him for $10 less. Okay? Now, the reason why this is puzzling is because it's completely inconsistent with our internal perception of the products that we discussed just 2 minutes ago, right? Which of these products did we imagine was competitively priced? This one, because you see we're making a very low margin, but somebody is coming and telling us that this price is too high. And we imagined that we were making a nice fat margin on the complex lenses, but our customer is telling us that it actually seems like a reasonable price. Okay, so you understand the feedback that we get from the market is completely inconsistent with what we imagined about what we described the products as when we looked at them from the inside. Now, what can explain this? That's the key question. There are two explanations, and I want to hear both explanations from the class. There are two explanations. One has to do with cost accounting, and the second one doesn't have anything to do with cost accounting. Okay? What can explain this? The fact that the feedback from the market is so inconsistent with our own internal data about the products. What's the explanation for these puzzling developments? So let's go into this. Okay, something might be wrong with the costing process. Specifically what? Okay, but can you be more specific? When something is wrong with the costing process, that means typically one product is overcosted and another product is undercosted, right? So can you be more specific about that? So that's one possible explanation. That's a cost accounting explanation. So it could be that our costing system is over-costing a simple lens by virtue of which we are overpricing it. So it seems like we're making a very small margin, but actually we're making a much larger margin because this number is too high. And by virtue of that, we might be under-costing the complex lenses. So we think we're making a large margin, but we might actually be making a very small margin. That's a cost accounting explanation. Now, this is not the only explanation that fits these facts. What is the other explanation? That's a possibility, or it could be that the other guy has a lot of economies of scale that you don't have, and so he's able to make it cheaper, or it could be that he has some other technology, some technique, some method of production, or like better suppliers who supply the material to him cheaper. It could be that he is doing any number of things that actually enables him to make the product at a lower cost than us. So that's something that has nothing to do with our cost accounting system. Right, if you want to carry that a little bit further, it could even be that the other supplier's cost is a reasonable cost, and in fact, it is we who are really bad at making the simple lens. Do you see how that explanation fits the facts? It could just be that it costs us way too much, more than it should, to make the simple lens, and then it shouldn't really take anyone $58.75 to make a simple lens. Okay, so it could be that we're really bad at making the simple lenses, but on the other hand, we're really good at making the complex lenses. So even to make the complex lenses and to sell them, even after charging a fair margin, our costs are so low that we are able to sell it to the customer at a reasonable price. So the question is, how do you distinguish between these two explanations? Okay, so chew on it, and we'll come back on Thursday and we'll finish.